Welcome to the STR Data Lab.
Hello and welcome to the latest edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at ODNA, and I'm joined again today with my co-host, Scott Sage. Scott, we've had a wild past couple months. How you doing?
Settling in. I think looking forward to covering this data with you. Good to be on again.
Yeah, so I feel like we've had some great guests the past few months, all sort of and talking about sort of challenges in the marketplace. And we saw RevPAR down again this month, 22 out of the last 24 months of declining RevPAR. I'm really looking forward to some good news to report. I have a feeling this isn't going to be the month, though. What do you think?
You know, I'll take the optimistic approach and I'll be future oriented and give the spoiler that there's some good news on the horizon, but you're right. It's been really great to hear different folks on this podcast give their perspective from many different seats and many different vantage points about the challenges they're seeing in the market. But what's the old phrase, Jamie, where there's challenge, there's opportunity?
Oh, yeah. And I think lots of opportunity there and I think we hear it with just about everyone of like, if you're doing the basics, if you're even going above and beyond in certain areas, like there's still the opportunity to compete. There's still the opportunity to make sort of decent returns. It just takes attention to the detail and understanding your market, understanding what's going to drive outsized performance. And part of that's why we do this podcast, right? To sort of give our clients, give listeners the edge on what we see happening out there.
Yeah, and frankly, it's a good reminder that we probably feel like this is a mature asset class and mature industry, but it's not. I mean, it's still fairly nascent. It's growing and it is maturing. And these are just some side effects of growth. Is you're going to see some ups and downs, and maybe roller coaster is a strong phrase, but we're seeing some of those peaks and valleys. And April, from a growth standpoint, maybe was the roller coaster coming down a little bit. But again, as we look forward, there's opportunity to rise. So enough of the analogies. Why don't we dig into the data? That's why we're here. And so, Jamie, what would love for you to just level set headline for us. What did we see in April from a performance standpoint?
Yeah, so let's run through it. So on the supply side, listings up 8.7%. We haven't discussed many months over the past few years where supply growth has been below 10%. So that one and I've got a little smiley face emoji next to this metric. So 8.4%, 7% is and seems pretty good. On the demand side, total demand nights, so on a stayed basis, up just 0.4%. So if supply's up 8.7, demand's only up 0.4. That gives us an occupancy decline of 8.4% on a year-over-year basis. So pretty significant decline there with the sort of weakness in demand.
Similar pattern we've seen really over the past 18 to 24 months here, where supply continues to outpace demand for the most part. But what's interesting is if you listened to this podcast earlier in I guess in April at this point when we were recapping March, you gave a heads up that we could expect this. So this shouldn't be a huge surprise.
Right. And that's where March was up 10.5%. If you look at the 2-month average, we're up about 5.5%. So, and a big piece of that was the Easter shift. So Easter was in April of 2023. It switched to March this year. With Good Friday and sort of the long weekend there is significant leisure demand that happens over that long weekend. And by shifting it from April to March, we sort of knew March was going to be strong, April was going to be weak, and that played out. So last month, occupancy was up 2%. This month, it's down 8%. We expect a more normalized month in May as sort of we get to what we call a clean comp. So data that's actually comparable on a year-over-year basis.
Yep, that spring break shift really is the driver here in this April versus March performance. You talked about listings growth. So we are now looking at 1.64 million listings active in April. How does that compare to pre-COVID levels? And just maybe give some historical context for that figure.
Yeah, so 1.64 million today. If we go back to pre-COVID levels, April 2019, we're at 1.16. So, and pretty significant growth over that 2-year period. It has been relatively consistent over that period. So, but and what I think is really important to call out when we look at this supply growth now is the relative weakness now that we're seeing in supply growth. So, and broadly, that's a combination of so many things. So, 8.7%, as I said, down from we were growing at 15.7% last year at this time. And 2 years prior, we were growing at 22.5%. So I said 2 consecutive years of declining RevPAR. It really started around this time in 2022 that supply growth really started accelerating. And now we're finally starting to see the deceleration happening in supply growth. And a big piece of that is elevated interest rates. We still see it. So average 30-year fixed mortgage is still above 7%. And that's up from and the 2.5% sort of back in 2020, 2021. We are seeing interest rates start to come down a little bit, like on a month-to-month basis, but still so much higher on a relative basis to both during COVID and pre-COVID that it's a big drag on listing growth and will continue to be a drag on listing growth going forward.
Do you have a sense for where we would expect to see interest rates need to land to change that figure in the supply number?
Yeah, so and how I think about sort of where interest rates are going to end up is one getting to sort of a long run expectation on 10-year treasury. And typically that is sort of the nominal growth rate in the economy. And I think most economists would say that that's should be about 3.5 to 4%. And then there's a typical spread between the 10-year treasury and the 30-year fixed mortgage rate. And historically, that has been about 1.5 to 1.7%. So that puts like an expected sort of 30-year fixed rate at like 5.5 to 6. And that's where I expect us to end up maybe in the next year or two, once we get through the sort of interest rate volatility and sort of move past some of the uncertainty around inflation. And 10-year treasury today is sitting around 4.4%. So I think we still have some way to come down there. And then the spread right now, sort of the difference between the 10-year treasury and the 30-year fixed mortgage is about 2.6%. So we could get a decrease of 1 percentage point in the 10-year treasury just from the spread getting more normal. And that should happen, but won't happen until we sort of get past this sort of inflation volatility sort of, and this sort of, will the Fed cut? Will they not cut? Like once we get some more certainty on that, then we should start to see the interest rates then the spreads start to come back down. So those of you waiting for 3.5% interest rates, like you're going to have to probably wait a really long time unless we go into another recession.
If ever,
So
right?
that's where I think most investors have started to get comfortable with that. And once we sort of start breaking through some of these mental thresholds of like getting average mortgage rates like below 7 or below, if we hit below 6, I think we could start to see more of a acceleration start to happen in terms of buying activity. And I think that's what most real estate agents sort of have circled is like, get us below 6 and we've got buyers and we've got sellers.
The magic number.
Yeah. And
Yeah.
a big part of that is buyers are sellers and sellers are buyers. So people don't want to give up their low interest rate to move somewhere else until interest rates come down, because they've got to assume a new interest rate when they buy a new property. So until that happens, until interest rates drop a bit, we're not going to see that sort of unlock of supply, but it could happen in a meaningful way once we sort of start breaking through some of these thresholds.
Really helpful. And as we look at where supply is changing by market type, this was driven primarily by large city urban experienced actually a 1% decline. So these listings are now falling in those urban areas. But what else are we seeing across these other market types in terms of supply growth?
Yeah, so urban down, and that's being driven primarily by New York. So first 4 months of the year, supply in New York's down 30%. New York's one of the biggest short-term rental markets, or was one of the biggest short-term rental markets in the country. But there's also supply is down 11% in Kansas City. It's down 5% in Phoenix, Scottsdale. It's even down 0.5% in San Diego. So some other urban areas sort of seeing declines. Sort of the core of the vacation rental market, mountain and coastal markets, seeing a increase of supply of around 8%. And then we sort of get to the sort of areas that keep on trucking. The small and mid-sized cities, growth still north of 10%, up close to 18%. So I'm still some significant growth happening out there in some areas, while some weakness and slowing happening in others. And I think for most people in the sort of traditional vacation rental market, that slowing is happening. There's not a whole lot of markets out there in traditional vacation rental markets that are seeing growth in the sort of 10, 15, 20% range that had been so tough to continue to grow off of, and that were causing the occupancy decline. So if you look at some areas now like Breckenridge, supply only up 3%, Poconos only up 2%, Sonoma up 1.5%, Panama City up 4%. So definitely some reasons to be optimistic. Miami, for the first half of the year, listings up 4%, but in April, listings flat on a year-over-year basis. So there's definitely some positive news out there for people that have been dealing with double-digit growth for a couple of years now.
And the message here is still growth. So there's still supply growth in the market, but likely a welcome signal to existing operators where it's no longer this double digit growth, and a slowing of that clip is actually welcomed for existing hosts and existing managers, where you can expect to see some improvement in unit level performance when the amount of competition coming into the market starts to slow.
Yeah, and we'll get into it when we talk about demand, but when you have supply growth slowing, and we've seen over the past couple quarters, demand growth begin to accelerate, there's going to get to the point where they cross again and where demand starts to exceed supply growth. And that's where we cross this threshold back to positive occupancy gains. And that's where at the beginning of the year, when we talked about the outlook for 2024, we had predicted that occupancy would turn positive in the back half of 2024. So now when we look at the first half of 2024, demand growth was about 7.5%. Supply growth was about 9-10%, but demand's accelerating, supply is decelerating. They're still on the trajectory to intersect for the back half of the year, and where at least we'll have not see further occupancy declines going forward.
So let's go there. I mean, so let's put supply growth off to the side and just supply off to the side for a second. Let's talk demand. And we have seen some ups and downs in demand growth in 2024 thus far, driven, as you said, most notably by the Easter and spring break shift. We had kind of the cold and impacting in January, moving some travel into February. But when we average this out over the first 4 months of 2024, we actually see that number, so demand growth being 5.5%. What are the key drivers here of demand growth, and what should we expect going forward?
Yeah, so a couple things. One, for looking at expectation for demand going forward, I am very focused on what's going on in the overall job market, uh, income market. So, do people have jobs? Are their incomes growing faster than inflation? If so, they're probably going to keep traveling. So, right now, and latest data is that April, we saw 175,000 new jobs. We still have unemployment rate below 4%. It was at 3.9% on the past reading. There's still real job growth happening. And that's flowing through into broader growth in consumer spending, retail sales, and still boding well for overall lodging demand. So I'm still very confident that demand will continue to grow going forward and that we're not going to see any significant national decrease in overall performance. That said, like we are seeing demand overall for hotels declining. We are seeing demand in certain markets and certain subsectors of the short-term rental industry declining on a year-over-year basis. So, and one way that, and we've looked at it in price tiers, and that's where we see lodging demand declining for hotels is in the economy in mid-scale sectors. When we look at short-term rentals, private and shared room demand's down. 1 and 2 bedroom demand is and flat to slightly positive. And where we see the most growth, the sort of expansion and new demand coming in is in those homes 3+ bedrooms in size. And that's where demand growth is still and very robust, up over 6% over the past 12 months.
That's interesting data on the back of Airbnb's earnings report, where there was a clear focus strategically on them getting more people on platform and facilitating and fostering group travel.
Yeah, and they sort of called that out in the earnings call and in the statement that they were seeing nights booked for groups of over 5 people had increased 15% on a year-over-year basis in North America. And that was the fastest growing segment in the region for the 4th consecutive quarter. So we're seeing in our data, they're seeing it in their public statements. So, and that's definitely an area where there's some tailwinds right now and where there's some clear headwinds for those operating in the sort of smaller unit properties.
Certainly. Yeah, I think if you're an investor maybe looking to deploy some capital right now, it's a trend to keep your eye on. Maybe you spend up on a larger property and the math should pencil if this demand continues to grow. So, supply and demand create what, Jamie? Occupancy trends. So what did we see for occupancy in April and year to date?
Yeah. So, and as I said, April, we were down about 8%, just over 8% on a 2-month basis. So it was up 2% in March, and we're sort of down 4% on a 2-month average. And that was relatively consistent with what we had been seeing prior to the sort of Easter shift. And January was down 6%. The few months prior to that were all down about 4%. So you look at, and over the past 6 months on average, we're at 4%. That's sort of where I feel that we're at. And that's where, and it sort of seems I'm pretty consistent. And that's not great. And obviously, we've dropped so much, we're now below 2018, 2019 averages. So when you look at the average over the 2-year period prior to COVID, industry was running at about 56%. And now on the past 12-month basis, we're averaging about 54.5%. So, and 2% down relative to pre-COVID levels in terms of occupancy. But that trend really differs by location type. So if you're in the mountain and coastal locations, yes, you've seen some big declines since 2021, but you're still above 2019 averages. And then you sort of switch over to the large cities and mid-sized cities. That's where, and again, we're down from 2021, but still well below 2018, 2019. So the weakness in the urban core is really masking some of the still relatively strong performance in the coastal and mountain markets. And that's where we're still waiting for inbound international to get back to 2019 levels. Americans are traveling 30% more trips overseas than pre-COVID levels, and we still can't get international travel back to pre-COVID levels for inbound demand. So that is a real big sort of headwind, and continues to be. That's something that I would have expected to get back like 2 years ago as international travel really began to pick back up. But the strength of the dollar has just been really made the US seem relatively expensive when you compare traveling to the US to other countries around the world because the dollar is still so strong. And we maybe expect it to weaken a little bit, but and there's not a whole lot that we can do to sort of change that.
And that occupancy trend makes sense when you factor what you just talked about in the first 15 minutes here. Supply growth outpacing demand growth is going to drive a reduction in occupancy over time. And if you're a host or an operator out there, you may be feeling this and you're not alone. When we look across the US, of 317 US markets, only 20 of those have experienced occupancy growth year over year over the first 4 months of 2024. And 3 of them have experienced year over year demand growth. And that's New Jersey, driven primarily by the New York regulations, San Antonio, and Dallas. Not sure what's going on in Texas, but everything's bigger in Texas, so bigger
Yeah,
numbers.
we're actually going to have a big report coming out that sort of talks about what we see going on in Texas, and some of the long-term demand trends really being beneficial towards the Texas market with sort of inbound migration to that state and all the subsequent job growth from that.
That's right. And so, as a host, it can be really frustrating when you don't see this occupancy growth like you had hoped. But there's some good news on the horizon, Jamie, with ADR. So, what have we seen thus far in ADR for the year, and what can we expect going forward?
Yeah, and ADR has been a bright point. We had expected it to be sort of flat to slightly positive this year. We have seen it sort of in the low single digit growth, 2 to 3%. Last month, we saw it up 2.7%, and it had grown faster than that because of sort of the Easter shift in March. So, really seeing some consistently positive trends there on ADR, which for an operator, if and you had the choice between 2% more occupancy or 2% more ADR, that 2% ADR is going to flow right to the bottom line. You don't have to sort of do any additional work for that. So it really points to how important revenue management is and staying on top of prices and eking out any additional dollar that you can to sort of drive profitability. So, and we had seen in 2023 sort of flat and declining anywhere from 0 to 5% declines in overall average daily rates. And that has, it seems, turned positive so far in 2024.
And as we look forward, maybe just as a forecast for the next time we're talking about a monthly report, what can we expect to see in May?
Yeah. So as of now, May's pacing up on the demand side about 10%. So if the demand pacing holds and the supply trends hold, that could mean sort of flat occupancy for the month of May. And then we see demand up anywhere from 10 to 15% as we head into summer. So that's where, and we could very easily, based on how data is pacing today, see occupancy turn back positive as we get into the summer travel season.
And we know with May, there are some two big drivers of demand here and ADR growth:
Yep.
Memorial Day and commencement. So university graduations are happening in May. So we cut this data and found some interesting information here. Maybe the headline around commencement is graduation on average across US markets contributed to 186% average increase in weekend booking revenue for college towns. So not your traditional vacation rental market towns historically or typically, but you can really use graduation as a driver of surge pricing, of increased occupancy and increased ADR.
Yeah, and what I thought was interesting and we'll link to the article in the show notes. We had done a deep dive in which market saw the biggest increase in demand because of graduation and commencement. And to me, it almost looks like a top 20 rankings
This
of
is-
college football.
I know this might look like the playoff rankings.
Right. Like you've got University of Alabama, Penn State, Florida State, University of Oregon. The only one that should have made the top 10 if we were looking at football, but didn't make it for short-term rentals was Athens, Georgia, and my Bulldogs. But they were just out of that top 15 ranking that we put out.
And we did a fun little comparison there as well, where we compared commencement in those towns to college, to the big football games. So, University of Michigan, their average ADR for commencement was $614. And we show you how that compares to their big game against the Ohio State Buckeyes, for example. And then we have Memorial Day as well, Jamie. So what do we see from Memorial Day across the US?
Yeah, so Memorial Day is pacing up strong, and we're seeing sort of right in line with trends for May, up sort of 10-15%. So, and we're pretty bullish on demand continuing to grow. Holidays are a time when you can really push rate. And Memorial Day is like this, I think it's like the second highest demand peak outside of sort of demand peak in the summer. So Memorial Day is really a time to push rate. Most everything gets booked up during that period. So, and it's this year looks to be no exception.
I mean, it makes sense, Jamie. That's the real start of summer. People are itching to go on some trips, maybe jump in some water, whether that's a beach or a lake, and that drives demand up.
Yep. And even stronger rates. So as I said, booking activity and up 14%. ADRs are trending up 7%. So where we've seen overall rates only up 2 to 3% past couple months, people pushing a little bit higher this Memorial Day. So trying to take advantage of that growing demand.
That's right. And look, maybe just as a PSA here, as you try to factor in all this data into your current property you're operating or looking at a new investment opportunity, you will see AirDNA look a little bit different in the coming weeks here, in that we've improved how we map our markets. And Jamie, you've been a leader in this initiative. Would love to give you some opportunity to explain it.
Yeah. So one is, and I've always felt when we look at our app and we look at our different tools, being presented with a list of 20,000 cities in the US to sort of choose where you're going to invest and sort of kicks you off on a process that seems almost impossible and insurmountable in terms of how do I choose among these 20,000 cities? Where am I going to invest? And then when I actually have a unit to invest, and I need to look at industry performance, when I want to look at comparing my listing versus my competitors, if we've got too many options, it sort of dilutes the data and makes many of those cities sort of unanalyzable. So you've got 17,000 of those 20,000 cities with fewer than 50 listings, which then means when you go in and like want to filter to just 3 bedrooms or look at just units with pools, like you can't filter down enough to make the data meaningful. So with the change coming up, we've aggregated the entire country up into 317 markets. And these 317 markets are sort of defined in vacation rental markets. So we have areas like, we've now defined the Adirondacks and Coachella Valley and Lake Tahoe, the North Georgia Mountains, Lower Hudson Valley, the Northern Cascades, like all these areas that people want to invest in and want to analyze performance in. You're now going to be able to dig in and see, okay, what is the performance of all the cities within the Finger Lakes district? And then when you click in that next level, then you can see each submarket, which for a lot of these areas are like the individual cities within it, but made sure that each one has a large enough sample size for the data to be meaningful. And then you can compare sort of the different cities within that overall market. So if you're looking at Coachella Valley, you can look at Indio versus Palm Springs, or if you're looking at the Adirondacks, you can look at Lake George versus Lake Placid and seeing how the different submarkets perform against each other as you sort of narrow down your market to invest in. And then within the major cities, like a lot of times the zip codes were just either way too granular or way too broad. So what we've done is instead of using zip codes, we're now using census tracts, and we're sort of aggregating those census tracts into really understandable, intuitive areas within that market. So like for Los Angeles, you've got 171 different submarkets within the market of Los Angeles. So you can compare Santa Monica to Manhattan Beach to Beverly Hills. Each one is named so you know what you're clicking into and then can see that area on the map. So we now have about 6,500 submarkets, each one of them named so you know exactly what area you're looking at and analyzing.
I'm thrilled to start playing around with this tool, Jamie. I think it'll make the entire experience easier. And two things stand out in my mind here: simplicity and power. I mean, one, it's more simple to find what you're looking for by aggregating these markets in an easy and intuitive manner. And then it's more powerful because we're combining the data without fragmenting it, which leads to dilution, which makes the insights far more actionable and powerful. And so kudos to you. I know you've been passionately working on this, and kudos to the team, and excited for people to use this.
Yeah, and I think it's going to be really interesting for users to be able to dive in, be able to like I've always heard of Lake of the Ozarks. I never really knew the cities. Like now I can like dig in like all right, what is the Lake of the Ozarks? What does that area sort of encompass? And then what are all the submarkets within the Lake of the Ozarks that I could then invest in? And then even and some of my favorite submarkets are we sort of dig into like rural Alabama and rural Arkansas and sort of carved out all the lake markets. So you can look in Alabama, like Lake Martin versus, and go into Georgia and look at Lake Jackson. So a lot of these areas that maybe were a whole bunch of smaller cities where you could never get a complete view of what was happening on that lake in terms of short-term rental performance. And now, and within 2 clicks, get to that.
You're like a modern Magellan with how well you know these maps. And this is coming from somebody who is horrible at geographies. I envy the skill. But I think that's it for today, Jamie. Really excited about the upcoming changes to the product. Really excited about what we're seeing going forward in the forecast for the industry.
Yeah, thanks, Scott. And I would suggest too, is if once people start diving into the new markets and submarkets, if you have suggested changes, feel free to reach out. We're going to be updating them over time as we hear feedback from clients. They're not set in stone by any means, but we feel like it's going to be a huge improvement for everyone out there.
Completely agree. Thanks, everybody.
Awesome. Thanks, Scott.